The war in Iran has caused a lot of damage already, but it might worry some people to understand that it might cause quite a bit more.
A defiant President Trump is pressing ahead with a new round of tariffs today after really a devastating ruling from the Supreme Court.
If your company faced these troubles, the Iran war and Trump's new 10% global tariff, they have already changed your risk map. In the next few minutes, we will show how your competitors are quietly doing three things and winning in a year. To help you know more, I've created a short China Opportunity Diagnostic for Western executives. Click the link below, you'll answer a few focused questions. My team and I will send you a personalized strategic analysis, where China can unlock billion-level opportunities and a practical roadmap. I'm Addy Choi, strategic advisor and an official mentor appointed by the government. Hit subscribe. I turn geopolitical shocks into practical China strategies that print money for Western executives. Freight surcharges, reroutings around the Gulf are compressing your margins. Trump's temporary 10% global tariff makes your 2026 cost models feel out of date every few weeks. Stay with me just 2 minutes. We will see the simple structure your competitors are using to reduce political risk and still capture China's scale. Number 1. They use Hong Kong as a shock absorber, a financial and legal hub that lets them keep China access while managing US-EU policy and sanctions risk. They redesign operations into China plus one plus Hong Kong, China for scale and capability, at least one alternative production sourcing base, and Hong Kong as the regional command center. Number 2, they align with China's current industrial priorities instead of yesterday's growth story, so they sit on the welcome side of Chinese policy rather than the scrutinized side. Number 3, they run a tariff and contracts audit now, baking this volatility into their pricing and terms instead of absorbing every new shock. You will know how you can copy the structure without betting your whole company on Beijing. First, business surveys are already showing growth slowing as the Iran war pushes up energy and logistics costs across sectors from retail to construction. At the same time, global trade is being reshaped again. A fresh 10% blanket tariff from Washington, talk of further hikes, and a new wave of de-risking from China policy from the US and Europe. Now put that against China's position. Beijing has set a more modest but still significant growth target, and is pushing hard on high-tech, green, and advanced manufacturing rather than just building more apartments. So while your headlines scream war risk and tariff shock, long-term capital is not exiting, it's repositioning. In a moment, I'll show you how Hong Kong fits into this as a bridge, not a battleground. If you sit on an executive committee, your dilemma probably looks like this. Regulators and politicians are telling you to de-risk from China. Your CFO's spreadsheet is telling you your P&L still depends on China for cost, capacity, or demand. And every new headline from Tehran or Washington makes your last China strategy deck feel obsolete before the ink is dry. So here is the better question. How do we redesign our China and Hong Kong footprint so that each new shock hurts us less than our competitors? Think of this as the MAPS playbook: market, access, policies, supply chain. Instead of asking, is China safe? The funds that are rotating capital into Asia are asking, which segments of the China market fit our capabilities and risk appetite? For example, rather than a vague China consumer strategy, they pick specific growth areas Beijing is openly supporting, like certain kinds of advanced manufacturing, green tech, or professional services, and avoid the politically radioactive ones. In a minute, I'll show you how they get into those segments without putting their headquarters directly in the line of fire. Here's the part most public headlines miss. Hong Kong leadership has been very explicit. They see the Middle East conflict and global volatility as a chance to attract diversification-driven capital, positioning the city as a stable, rules-based hub tied into mainland China. Middle Eastern and other global funds are already increasing their use of Hong Kong, both for stock market inflows and as cornerstone investors in IPOs that give them controlled exposure to China. For a Western firm, that means you do not have to choose between fully in China or fully out. You can hold regional assets, JVs, or financing vehicles in Hong Kong, using Hong Kong law, banking, and listing frameworks that both your board and major global investors already understand. Then connect into the mainland operationally where it makes sense. In the next section, you'll see why this only works if you understand both Western and Chinese policy logic. Right now, your risk is being squeezed from two sides: US-EU tariffs, export controls, and screening regimes; Chinese industrial policy, data rules, and national security concerns. The playbook sophisticated players use is simple but not easy. Map your China-related activities against Western red lines: technology controls, sanctions, sensitive sectors. Map the same activities against Chinese red and green zones: encouraged industries, negative lists, data localization, and security. Then they redesign structures so that high-risk activities are ring-fenced or shifted to friendlier jurisdictions. Policy-favored activities are concentrated in places where Beijing actually wants foreign capital. Finally, supply chain. The Iran war has already forced shipping and insurance companies to reroute and reprice, and analysts expect this to last well beyond a single news cycle. The firms that come out ahead are not the ones that cut China, but the ones that move to China plus one plus Hong Kong. China remains your production or demand engine, where it clearly outperforms. Plus one is at least one alternative base in another friendly jurisdiction, even if it's more expensive in the short term. Hong Kong becomes the coordination, financing, and dispute resolution hub, tying it all together. This is exactly how some Middle Eastern and global funds are structuring their Asia bets. Diversified routes, but still pointed at China's scale. So what happens if you actually execute some version of this over the next 6 to 12 months? Each new Iran war headline or Gulf shipping disruption hurts you less than competitors who still rely on a single corridor. Each new tariff, export control, or de-risking speech triggers structured responses you've already priced into contracts and governance, instead of emergency Zoom calls at midnight. And instead of chasing China in, China out headlines, you quietly sit alongside the capital that is using Hong Kong and mainland China as one of their safest long-term bets. If you wait, then your competitors win. Want a concrete version of this for your company? The link is below. No theory, just the practical roadmap I build with Western CEOs in my Star Plus Maps consultations. We take your exact footprint and design a Hong Kong-China strategy that survives war, tariffs, and politics by design, not by luck. Hit subscribe. Every week I turn geopolitical shocks into practical China strategies that print money for Western executives.